Japan just declared an emergency, one that is threatening to crash their entire financial system. Now let's head over to Bloomberg, where he picked today's story up, because as you're about to see, they're not the only ones sounding the alarm. As Japan bonds plunge this week, auction adds to fear over Bank of Japan retreat. And right now, this is a major fear for industrialized nations all over the country, that central bankers are going to continue to keep interest rate policy elevated and perhaps even raise rates over the threat that tariffs are going to send inflation higher. And I want you to think back of what the bond market told us here in the United States, because when we saw interest rates spike, what happened? Well, all of a sudden, hedge funds were forced to liquidate, sending rates even higher. Equity prices came crashing down, and next thing you know, the financial system was on the brink of insolvency. This is the same issue that Japan is now facing. The problem is they don't have an answer. The surge in yields underscores structural challenges, particularly Japan's debt market, along with the concerns of bond investors globally about the risk posed by rising government spending. And this is a key point here, because what investors are telling governments all around the world is, if you do not get your fiscal house in order, we're going to punish you by dumping your bonds, driving interest rates higher. And this is a problem, because when we look around the global economy, we see that it's slowing down. And this is the point where you want governments to be able to step in and spend and put support under the economy, but the bond markets are very clearly saying, look, you can't do this. Now you think back to post-pandemic, what should have happened is government should have cut their deficits, they should have cut their debt down, but everyone believed we're at the beginning of a massive economic boom. The problem is governments kept spending, and now the bond markets are telling them, you can't do that anymore. Key Japanese buyers like life insurance aren't stepping in to fill the gap as the central bank scales back its purchases of the nation's bonds. And we're facing the same issue here. So what Japan needs is someone to come in and buy their debt, but insurers are saying we're not. And what do we need here in the United States? The commercial banks to buy our bonds. And that's why all of a sudden there's a lot of talk about the Fed potentially relaxing the SLR, or supplemental leverage ratio rule, to get people to buy all this debt. Because right now we're facing a major problem. The global economy is slowing down, and governments have taken on a massive amount of debt, and what they're doing is they're constricting the real economy here, and that means, of course, demand for bonds. In the short term, it pushes rates up. Over the long term, it'll bring them crashing down. The result is that Japan's bond curve is the steepest among major economies, even as yields globally are being driven higher, including U.S. Treasuries. So what we're seeing investors doing is turning their back on the bond market. They're going short, they're dumping them, and this is causing dislocations in the curve. But this is going to impact consumers in a major way, because if you think about this from the consumer perspective, in a slowing economy, what do we need them to do is spend. But if interest rates go up, not only their debt service costs going higher, their desire to borrow and spend is going to go down. Let's talk about the issue here with what's going on in Japan, but we're going to look at U.S. data here. We're going to look at the Treasury yield curve, which is 10-year minus the 2-year in blue. Now, normally you see a rising yield curve, and this is a good sign, but at least what it means is rates are coming down. And the problem is, it's usually led by the Federal Reserve cutting rates. Here you can see the federal funds effective rate in red going down each time. Now, the problem in Japan is we're seeing just the opposite. The BOJ is raising rates. They're trying to tighten policy to contain inflation, and the long end of the curve is breaking out. And what that means is the long end of the bond curve is telling us we're expecting inflation to go up from the tariffs, and in a major way. At the same time, growth is going down. So what we normally see in this historic pattern, the curve is led by, of course, central bankers cutting rates. We're now seeing the exact opposite, and it's a huge problem for financial systems. I don't want to touch super long bonds, said one fund manager. The only way to improve market sentiment for super long bonds is for the authorities to take action. And what he's telling the BOJ very clearly here is you need to stop unwinding your bond portfolio, and you need to cut rates. But again, the problem is central bankers believe their policies can contain inflation. And in some sense, they can. Because if financial conditions are tightening and the economy is slowing down, how do you get people to stop spending? Well, one way is to drive rates higher. But while there may not not be demand for super long bonds, there should be demand for uranium. Let's take an update on our trade, now up 15.9%. We put this out to our CTA Timer Pro subscribers back on April 24th. We noticed that machine positioning was set where they were going to become big buyers. And we're going to look at this chart setup again at the end of the show. We think there's another 7 to 17% upside in this trade. Now, if you want to get in on this and some of our other big trades and beat the machines, all you have to do is grab the links in the description below, use a coupon code for your free 30-day trial. Stay tuned to the end of the show for more information. Because when we talk about bond yields and the economy, it's all about growth and inflation expectations. Let's go back to some U.S. data here and look at the consumer price index average with real GDP in blue against 30-year treasury yield. So we don't have a super long bond, but that's as long as we've got that one in red. And what you can see happening in Japan is they believe inflation expectations are going higher. In this case, you see the blue line going up, and that means yields go up. And you can see this happen here in the U.S. data over and over again, except for now, what do we see? Growth and inflation expectations in blue going down. At the same time, the markets say, no, we believe it's going up. And again, this is a major problem because what happens is you start to get some VAR risk in the system where people who normally hold bonds want to sell them. People who would like to buy them don't want to because they think rates are going up. You start to see liquidations, and next thing you know, they start to spiral out of control. But again, the fear of rising inflation has central bankers in a position they can't respond. And that's exactly what the Fed did. What's likely the Bank of Japan's going to do? They're going to do nothing here, but it's going to impact consumers and businesses who really need rates to come down. They need to see some relief from the interest rate market here in their finances, but the bond market say no, there's more pain to come. Of course, we know when growth and inflation expectations eventually reverse and come down, rates will come down with it. But the problem is it's going to involve a crash in the economy, one that could spread from Japan all over the world. Rather than doing things that might create speculation like speeding up or slowing down the pace, referring to their runoff of their bond portfolio, the Bank of Japan should just reduce purchase systematically at a steady pace or stop the cuts after initially announced period, suggesting this is all up to messaging from the Bank of Japan, that they need to tell the markets, look, we're going to stop selling off these bonds because right now the Bank of Japan owns more than half of the BOJ market. They don't want to keep a big position, but the problem is investors are saying if you don't buy them, the pain is only beginning. Some participants were of the view that a weakening of the supply and demand dynamics for the super long bonds is structural, and the central bank may have little room to maneuver in order to rectify the situation. Well, in truth, we do know if central bankers cut rates and go back to buying bonds, interest rates are likely to come down with it. But the real issue here is what the bond markets around the world are telling us is there's going to be a shock to the global economies due to these tariffs. We're likely to see inflation go higher. But the problem is when inflation goes up and growth slows, you go right into a recession. Any bump in inflation becomes transitory, suggesting there could be an opportunity to buy bonds at some point here in the near-term future. And here's the evidence, of course, when you see that interest rates going up as we look at the 30-year treasury yield again in red against real GDP in blue. And you can see that when rates go up, when the economy is slowing down, it really causes demand to drop because consumers cut back their spending. You can see here in the late 1990s, it pushes us right into the dot-com bubble. You can see that happen going into the global financial crisis as a rise in rates put another damper on growth and pushed us right over the edge. And now what are we seeing? Markets believing rates need to go higher and higher and higher. And yet what do we already know about the U.S. growth rate? Well, it's coming down and likely to come down even more, suggesting that these move higher in rates by the market and investors is going to get reversed at some point, but not before it creates massive amounts of pain. Buy now, pay never? Klarna's losses double as U.S. consumers fall behind on payments, and you can see the effect of interest rates where they're at today. Consumers can't even afford to pay on their debt as we see more of them start to slip into delinquency and default. And yet what is the investor market saying? Look, rates need to go even higher. Governments need to cut their spending. The problem is if governments cut their spending at this point, a recession becomes a foregone conclusion. But if they don't, well, we're going to have a recession anyways because consumers, as you're about to see, can't afford higher rates. In an absolute shocker that you'll never believe, Klarna, the Swedish financial technology firm known for its buy now, pay later offerings, reported a sharp increase in the losses for the first quarter, driven by a rise in consumer defaults and economic unease in the United States. So what we're seeing, U.S. consumers unable to pay these short-term loans, going into default. Now keep in mind, a lot of these loans are 3 or 4 payments, and that's it. And what we found out is a lot of Americans turned to these as inflation went up, and now all of a sudden, because inflation continues to rise and paychecks relative to that continue to shrink, they're defaulting on these loans. And the issue is, if rates go even higher, you can tell there's going to be even more pain to come. Let's take a look at the delinquency rate on credit card loans at all commercial banks in blue against the commercial bank interest rates on all credit card plans in red. And you can see the periods where you see rising delinquency rates, as we did here in the late 1990s, that were matched by rising interest rates, led to a complete collapse in interest rates and the dot-com bubble. At the same time, it didn't do anything to really slow down the delinquency rate. We see it happen around 2006. The delinquency rates on the rise. Banks are still pushing rates higher thanks to the Fed. Next thing you know, financial crisis, rates come crashing down. And now look, we're seeing one of the highest level of consumer interest rates on credit card debt in decades. And yet, what are we seeing in the delinquency rate? It's rising. And right now, Klarna is saying, look, there's no sign this is coming down. But there's a big issue here that's really obvious. People aren't paying interest on these loans, which is telling you there's a major problem not only with the U.S. economy, but the global economy. The company posted a net loss of $99 million for the 3 months ending in March, more than double its $47 million loss during the same period a year earlier. The deterioration comes amid a rise of consumer credit losses, which climbed 17% year on year to $136 million, underscoring mounting concerns about the financial health of U.S. borrowers. Again, at the same time, what are we seeing investors telling the Bank of Japan? We're going to drive rates higher unless the government gets its fiscal aggression under control. What are we seeing here in the U.S.? The same issue. The market continually wants to push rates higher. They believe inflation is going to be an issue. The central banks are going to stand pat. But one thing we do know, the cure for higher prices is higher prices. In addition to that, higher prices with higher interest rates. And you're going to see this thing come unwound in a big way. Because the issue that's facing Klarna is the same issue facing the delinquency rate on credit cards, and that is shrinking paychecks relative to higher prices. Let's go back to the mid-90s. What do we see? The delinquency rate in blue is on the rise. At the same time, average weekly hours of production in non-supervisory employees on the decline. So you can look at these different cycles. We see it happen here in the late 90s into 2000s, going into the financial crisis, is that consumers are on the edge financially, and as their hours get cut, what happens? The delinquency rate soars. Now, what's interesting about the current cycle is we saw that happen when hours worked fell under 34.2. So if you're wondering why this recent boost in hours really had no major effect on the economy, is because it all went to absorb higher prices. What we should expect going forward, what Klarna is telling us right now, is that consumers here in the U.S. are in a dire situation. Japanese consumers are going to face the same issue as investors drive yields higher. Only what we're going to find out is at some point they're going to come crashing down. In Klarna's business model, providing interest-free installment loans for retail purchases, which doesn't sound like a very good business model right now, has grown rapidly in recent years, especially in the U.S., where the company has partnered with major retailers as Walmart, eBay, and DoorDash. And that's right, people are actually buying their groceries, if you can imagine, and ordering food out on these 4-pay plans. What do you think about that? Weigh in the comments below. I think that that's a sign not only of financial stress if you're buying your groceries, but really, it doesn't make any sense if you're ordering DoorDash on a payment plan. Despite the growing defaults, Klarna emphasized the short-term nature of its loan book, noting that 83% of its balances refresh in 3 months, and that could be a major problem because based on what we're seeing in the U.S. economy right now is it's continuing to slow. The impact of the trade war is starting to hit. That means a lot of workers are going to see fewer hours. Fewer hours, as we know, is going to lead to more defaults for Klarna and, of course, more delinquencies in the credit card space. The company said in a statement it's closely monitoring changes in the macroeconomic environment and remains well positioned to adapt swiftly if required. The question is, how do you adapt swiftly when you're charging people no interest for loans and they're starting to default, and that rate is at 17% year over year, and I bet it's going to increase significantly from there. And that's why we saw from Home Depot last night that the CFO said the retailer doesn't plan to raise prices due to tariffs. The reality is they can. As we're seeing from Klarna, consumers can't even afford afford their debt service costs now, even when they're not charged interest. And this is a problem because it means they can't afford higher prices. Home Depot knows this. Walmart warned that they didn't want to, but were facing a position where they had no choice. Home Depot saying we're standing pat. They think they're going to come out okay. I'll show you why Home Depot's not. Because of our scale, the great partnerships we have with our suppliers, and the productivity we continue to drive in our business, we intend to generally maintain our current pricing levels across our portfolio. Again, this is all because they know consumers cannot afford higher prices. They could raise them if they want. They're just going to get rejected. The decision to keep prices the same, at least for now, also comes as a sluggish housing market causes the retailer sales to stagnate, and that's exactly the point. As we see things slow down, it means the housing market's going to slow down, and that means for a lot of retailers, particularly like Home Depot and Lowe's, things that they think right now are okay are about to get a lot worse. Let's take a look at new privately owned housing units started in blue against real retail sales in red. Now let's go back to the mid-90s. What do we see? A slowdown in housing has an immediate impact on real retail sales in red. You see it happen around 1999 into 2000, same effect. How about going in the dot-com bubble? As far back as 2005, housing starts plunge. That means retail sales go down with it. And now what are we facing today? We know that builders have the largest inventory overhang since the financial crisis. The economy's slowing. Building permits are already starting to get cut, and that means retail sales likely to drop. If you want to know the real reason, again, coming back to Home Depot, the reason they can't raise prices is they know it won't work. Consumers will just reject it, and things are going to be even worse for them than they already are. But the evidence of the trade war impacting paychecks, well, there's one place we can see it very clearly, and that's Los Angeles. As LA port shipments fell 30% in early May after Trump tariffs. Fewer containers mean less work on the waterfront from the number of labor gangs that are out there responding to the shift requirements cargo to the truckers and warehouse workers. So if you're wondering if this Klarna issue that they think they're able to respond to is going to get better, not a chance. Because again, if people can't pay on interest-free loans, what's going to happen as their paychecks go down even more? And again, we think about credit card delinquencies. When's the first things that people stop paying on when they get into financial difficulty? That likely to get worse. The impact was felt almost immediately during the first week of May, and we know that's going to get worse in the weeks to come because even though we're seeing some of the trade war start to get resolved, it's not going to happen fast enough. I told you there was going to be a shock to the economy. We're seeing it happen right now in real time. In Japan, it's happening in the bond market. Here in the U.S., we're seeing it at the consumer level. And they know that exports declined for a fifth month in April as other countries responded with retaliatory tariffs, particularly for U.S. ag and manufactured goods, meaning the heartland of the country is also about to be impacted at the same time. We're seeing workers at the Port of Los Angeles and the surrounding areas start to be at ground zero of this trade war. So as we go back and look, we can start to find out why Japan's declaring an emergency, because they have absolutely no response to what's going on in the bond market. Central bankers in a position, can they cut rates? Highly unlikely here, but at the same time, look what's happening in the U.S. The Fed says we don't want to cut rates, but U.S. consumers are failing financially under the stress of higher interest rates and higher consumer prices. What you're seeing here, my friends, is a perfect setup. One that could plunge the global economy right into recession. But talk about setups, let's take a look at our trade on uranium. We put this back on in April. Told our CTA Timer Pro subscribers to buy here on the open because we noticed not only technically there was a great chart setup, but the machines were likely to buy based on our models, and sure enough, they did, and in a big way. And as of today, is trading, what we see is sitting right on top of its 6-month volume profile. If it can hold price here, it's likely setting up another 7 to 17% move higher. Now, how do we do this? Each and every day, we look at the machine positioning across the broad equity, bond, currency, and commodity markets, and we've backtested all our signals so we know which signals that hit have a good chance of generating a positive return. We publish that right into our hot list each and every day, but you also get the machine positioning across all the broad asset classes as well. You get the daily report. You get all the tradable signals. You get my opinion on the best trades. You get risk control levels and updates on those along the way. We give you full tracking of all our open trades and returns, a weekly update, and here's the best part of all, you get a 30-day free trial. That's right, we're so confident that you could trade against the machines and win using our report that we want your first 30 days to be on me. Grab the links in the description below, use the coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.